And now it's my great privilege to introduce a guy. His name's Michael Klein. I am absolutely not going to read you his very impressive 1.5-page bio that is in the conference books that you received this morning or before. But I'm going to say a few things about Michael and then let him speak to him. I will tell you that he is the chairman and co-chief executive officer of Citi Markets and Banking, with primary responsibilities for corporate client coverage and global transactions, and that he is a member of all of the leadership groups at Citi and is in the place and sitting in the spot to make a difference. But the rest you could read. What I want to tell you about is when Citi rolled out their $50 billion climate program, and I'm sure Michael will tell us a bit more about that, I was at a meeting at their offices. And the most important thing I remember, and I came back, were several important things. One is it was in the middle of the subprime financial crisis. Citi stock was being shaken that day like many other leaders in their sector. And Michael walked in and did not talk about that, but talked about why climate was as important as those issues, and focused on climate and the need to integrate it and act on it with religion, with force, with power, and with a clear understanding of what it meant to one of the world's leading financial institutions. And when we asked him, how deep is this integrated in the bank? And at times of difficulty, over the years, what we've seen at difficult times, sustainability issues get pulled back when we're in tough times financially. Is that what's going to happen at Citi? And Michael said, this is so deeply integrated into every single part of what our firm is about, we couldn't pull back if we tried. That's been affirmed day after day. I look forward to hearing more about the leadership work of Citi and invite Michael Klein up here to share that. Thanks, Michael, for being here.
Well, thank you very much, Mindy. Sort of unfair when someone has $5 trillion behind them, that much in the way of impressive facts and that much passion. It's not fair to follow that person, but thank you, Mindy. I should also say that Mindy's comments actually are a perfect lead-in to what I'm going to say today. It's actually really a pleasure to be here. As a banker arriving in Boston, one of my colleagues said, "Are you here for the big hedge fund conference?" Actually, I'm very happy to be here with Ceres. I'm happy because obviously Ceres has a long-standing commitment to sustainability, but more importantly, the issue of mobilizing capital markets, financial investors, financial institutions on such an important set of issues, in particular regarding climate change, in particular regarding the impact of global warming, is something that has great resonance for all of us at Citi. Let me make no bones about this. Let me be clear. Let me leave you with no mistake about it. Citi is deeply committed to productive changes, policy initiatives, and investments towards addressing all aspects of carbon emissions and climate change. Let me make no mistake about that. From the top of the organization down throughout the organization. Let me also say that this is also in our self-interest, because banking is a business of trust and relationships. It's a business of advice and risks, and understanding that climate change, global warming, greenhouse gas emissions presents one of the single greatest challenges for corporations, governments, and investors, our core clients, for the decades to come, because investments they will make, which are decades in the making, which are billions of dollars in the commitment, will be either made for the benefit of the future or will made at the cost of bad practices. We need to give them that advice. So it's critical for us. Now, this conference provides a unique link between a number of different worlds, and that's why it's really a pleasure, Mindy, to have the opportunity to speak with you. I am, however, a banker. I'm actually a bit of a homeschooled banker. My father was an investment advisor for about 4 decades, and he was what I would consider to be a great fiduciary, a real trusted individual. And he explained to me in one of the many tutorials, I required a lot of tutorials, that in good markets, investors look to next year. In great markets, investors look to the future, which is not very easy to define. And in bad markets, investors think a lot about yesterday. Well, we've had a lot of yesterdays recently. And as a result, we've had a lot to think about. What I'm going to do is I'm going to spend a few moments before going through our initiative to discuss a bit about the markets, because I think today one of the great questions of the day, with Mindy's key intro, is, will the momentum continue, or will the current crisis in the investment markets and the upcoming decline in the real economy, will it slow some of the commitments? That is the question of today that I'll pose. First and foremost, as a banker, I've had a front row seat to some of the center of the storm, so I'll try as best as I can, as briefly as I can, to give some insights. But put simply, we're living today in extremely challenging financial markets. For all participants, we're in the 10th month of a financial market liquidity, confidence, significant set of issues. We're probably 2 years into a U.S. real estate value decline, so we are deep in the midst of a series of factors impacting many of you as financial institutions or investors. We are living through a period that clearly comes on the back of fantastic economic expansion, unprecedented amount of liquidity. So the change is one that's even more dramatic. To set the stage, the pace in the decades of 2000 to 2007 was really quite extraordinary. Not only did we live with incredible capital formation over that time period, the growth in the issuance of capital. By 2006, 2007, nearly $7 trillion per year of new equity and debt was issued. I point that number out because that's twice the amount that was raised even during the peak of the internet bubble. This amount of capital raised, this unprecedented liquidity, came as a result of a fantastic amount of growth globally. We've had the longest, deepest, most diversified growth trend in the history of recent financial times. 100 countries growing at more than 4%, 4 years in a row of record economic growth, 8 years out of 10 of record economic growth, a terrific amount of growth when married with prudent fiscal management, reducing the perceived risk and reducing the perceived volatility in the marketplaces. But beginning almost a year ago today, that changed. That change was very meaningful. It started in what you've all read about, which is a small corner of the world, the so-called subprime mortgage market. That small corner of the world triggered a series of issues in what have turned out to be the weaker parts of the financial system. And those are parts of the financial system that had significant leverage against significantly weaker assets. As that part of the financial system continued to shake, it rolled into better and higher quality asset classes. And that has caused a truly troubling set of dynamics in the world of funding and financing. So for all participants that either require capital to do their business, to grow their businesses, to grow their technology, or those that seek to invest capital, the markets have been extraordinarily challenging. To give you a sense of this, since the start of 2007, globally, banks, brokerage firms, and the like have seen approximately $275 billion of pre-tax losses. These are extraordinary sums of money when looked at even on an independent basis. But try to put that in perspective. That's about 7 times more than the U.S. spent to support research and development on domestic and international climate change programs from the entire decade of 2000 to 2007. It's about 7 years of climate change adaptation, investment in agricultural, health, water, and coastal protection, according to the UN. These are very big numbers. If you take into account the leverage that financial services firms operate with, they leverage their equity base to provide capital to companies and individuals. If it were not for central bank interventions and significant capital raising, those losses would have magnified into $4.5 trillion of capital taken out of the financial system. Implicitly, the entire investor base of Ceres removed, as an example, just analogous from the financial system, if not for new capital raising and central bank intervention. And of course, key organizations, including venerable firms such as Bear Stearns, teetering on the brink of bankruptcy, only to be bailed out at a fraction of what was their prior book value. Now, in addition to all that, the U.S. mortgage market, which is very large, it's about 1 times our gross domestic product, about $11 trillion, still remains challenged and poses challenges in the future. So I say to all of you today, the financial system has gone through significant challenges. The impact of these financial challenges is only now becoming an issue for the, quote, real economy. Most economists believe we're in the midst of either a slowdown or a recession in the U.S. Citi's economists believe that we are in the midst of a recession. That recession could continue for 12 to 18 months in terms of the U.S. It's less clear how much this recessionary activity will move overseas. Clearly, Europe has a strained financial system today, and clearly Europe is seeing the beginnings of some of the economic slowdown as well. There is a question of how dramatically this will impact the rapidly growing emerging economies, which have been the engine for much of this economic growth, particularly in Asia. This so-called question that's been posed by economists of a decoupling from the world's economy. China is still growing at over 10%. Perhaps a slowdown will moderate their already very, very high steam economy. Indian output continues to be at up over 8%. Why do I raise this? I raise this because the continued strong growth in the emerging markets poses the second part of the question which is raised today, which is, will the momentum for climate change initiatives continue? And the second is, of course, that this continued growth creates demand for raw materials, demand for energy, demand for basic commodities. Of course, those are core parts of the climate change, the global warming, the carbon emissions question. But more importantly, as you will note, this demand has caused an increase in commodity prices that's really quite dramatic, with oil hovering at about $120 per barrel. Oil remains this high. Some believe because of speculation, I think less. Some believe because of potential securities fear, I think some, but mostly simply because of supply and demand. And of course, with demand expected to continue to increase, the OECD expects 50% increase in demand over the next 20 years, 70% coming from the developing countries. Even if we are to develop substantial new forms of alternative supply in the coming years, it's hard to imagine that we will so dramatically overwhelm the need for the use of oil to drive those prices down substantially. And as a result, you have most producers seeing floors in the pricing of oil that are really not even discussed in the past. $60, $80, $90. If you pick up one newspaper this morning, one particular individual asked the question that I've never seen before, which is, could oil be a $200 commodity? Now, what do the challenges in the financial market, the challenge in the U.S. and international economy, and the price of oil have to do here? Well, of course, they have to do, fundamentally, with the question of momentum with the initiatives we've discussed. We must admit that these headwinds pose a risk for corporates as they invest in climate change. Being responsible for the actions that Mindy describes require financial and human resources, and there is no denying that the corporate sector, the financial sector is and will be under strain in that regard. Return hurdles are higher, be they for green projects or other projects. Human resources, time spent when there's a reduction in headcount is an important question. Now, we know this to be the case. It's very, very easy when times are great to think about the future, and it's harder in times of challenge. But let me say the following, and I believe this with great confidence. I believe that the momentum that's been building in the U.S. private sector will not be lost. I believe when it comes to this issue, we will find that we can look back on the period of 2006 and 2007 as a fundamental turning point. I believe we'll look back and we'll recognize that that was the date that science, governments, mainstream, and business all collectively realized that there was not just a social, but an economic cost, not just an economic cost, but an economic opportunity revolving around the entire issue of climate change. I think the mobilization of U.S. industry has taken some time. It's taken some time in power generation and consumer goods, in all forms of infrastructure, all forms of transport. But I think the commitments that have been embedded are largely that, embedded in the industrial fabric. Now, outside of the U.S., Europe has likely more of an embedded focus, both because of legislation that's put in place, a longer tradition, and also perhaps slightly less stress, at least right now, from an economic perspective. But in addition to this imperative felt by industry leaders, I believe today there's a far greater understanding in the value and the potential return on investment in all areas that impact climate change. I believe that there is a recognition, an increasing recognition, being further increased by commodity price changes, of course, that the opportunity for new investment in this space is extraordinary. Now, you're all aware, because we've discussed this, and you're aware, of course, in general, of the meteoric rise in oil price. At $120 per barrel, oil is a roughly $5.5 trillion industry every year. It's a mammoth industry. It, of course, is creating great shifts of economic and activity and wealth. There's no doubt today that there is an extraordinary incentive to create alternative energy. There's no doubt that these incentives are being felt at a company level. They're also being felt at a country level. Higher energy prices are clearly driving the development of alternative energies, and quite frankly, any of the items that might have been attractive at $40 oil, that might have been attractive at $80 oil, are of course far more attractive today with $120 oil. I would go as far to say that even those producing countries, such as Abu Dhabi, which has somewhere in the range of 10% of the world's oil, recognize this. The great oil-producing countries are generating somewhere in the range of $2.3, $2.4 billion per day of investment dollars. Some of it they're now placing directly into alternative energy. I'd only note the Abu Dhabi Masdar initiative, which has taken the point of view that Masdar City will be the first zero-carbon, zero-waste, car-free city, which hopes to attract not just top minds, but scalable, non-lab-based, scalable opportunity investing in everything from carbon capture to a wider range of items. Now, there is a possibility here that these current market conditions will sharpen the focus. They will weed out initiatives that probably weren't sustainable. They will make sure that those that are sustainable continue to be sustainable, and they will drive more initiatives. Now, I'd ask you to think back to the last cycle that felt a little like this cycle, 1990, 1991. Real estate, financial challenges. You could read the headlines, and they're almost the same headlines as today. Investment bank fails. Drexel, Bear Stearns. Middle East investors investing in major banks. Citi then, Citi today, UBS, Merrill Lynch, and the like. Focus on capital and accountability of the financial system, 1990, today. What happened post-1990-91 was a dramatic investment by the country in productivity and technology. It was the next great wave of not just alternative telephony, the internet, productivity-enhancing, just-in-time business, manufacturing, and distribution tools, which dramatically drove our economy. I would say to you, in my opinion, challenge creates far greater impetus for innovation than prosperity does. So this window we face today could just as well be, while not as clear because we're in it today, a window similar to that we felt in 1990-91. I need only remind us that by 2000, the value of the equity markets had increased sixfold. The economy had grown dramatically. The wealth of the nation was far higher, and that continued through till 2007. Now, Citi is an example, frankly, of all that I've just described. Citi has made a commitment that goes as far back in climate change to a group of senior leaders, one of which is here, Pam Flaherty, back in 2002, when we decided to take action to reduce our own environmental footprint. We did so because a few within the senior leadership thought that this was not only the right thing to do, but also because we advise our clients, because we lead our clients, because we want our employees to act as ambassadors leading our clients, we wanted to embrace this which we thought was essential. Now, as many as you know, and as was described by Mindy, we announced last year a $50 billion target over 10 years to address global climate change through both investments, financing, development of alternative energy, clean technology within our business, in other businesses that our clients do. We're very pleased because this is real money, real companies, real investments. We're very pleased that in the first year we exceeded our estimates, $6.4 billion. That $6.4 billion is spread through the whole business, 5.8 of which comes from our markets and banking business, much of which comes from direct lending or investing in projects, some of which I'll describe to you in a moment. And even in these challenging market conditions, we've exceeded our goals. We're pleasantly surprised by the numbers. We've also tried to embed this deeper. We've created an internal technical advisory group to oversee both technological and accounting measures here. We want to make sure that this works, that it's documented, and that we can extend it. It's not just business as usual. We've extended deeply into the business. In 2007, we took what was a small alternative energy investment practice in our investment area, and we created Sustainable Development Investments, which is a private equity group. That group is expected to earn returns and will earn returns on the kind of investments that they make, but they will be related to renewable, alternative energy, clean technologies, water management, waste management, energy efficiency, sustainable forestry, and environmental emission reduction credits. In 2008, we hired some of people we think are some of the best and brightest minds, and we created a global alternative energy group within our investment bank. The idea is to provide financial solutions to meet the significant demand from our clients in the alternative energy space. And the range of activity that we have put in place, I think, is exciting. I think it's impressive. I think it shows off what our organization can do extremely well, but it shows off what the practice of creating alternatives, the practice of focusing on efficiency, mitigation, and renewables is deeply embedded in our clients and in ourselves. We're an equity investor in something that is, I think we're quite proud of. It's a syndicate led by MMA Renewable Ventures. Some of you may know about it. It's a 15-megawatt photovoltaic installation at Nellis Air Force Base. This is 70,000 solar panels. It's created to sell predictably priced energy to the Air Force Base, long-term contract. As a result, the system will be up and running, cash flow positive immediately. This is the first time that there's been an investment structured for debt equity placements of this form of solar investing. In China, we provided Dragon Power Technology with financing to build 125 biomass power plants in the various provinces in China. That'll create 1,866 megawatts. It'll use agriculture, waste, feedstock. It'll generate carbon credits for sale. We also allowed for the funding of a key purchase of a biomass boiler supplier that was critical for this particular company. Citi also worked with a group called ArcLight Capital Partners to acquire 3 geothermal facilities, which will produce 258 megawatts of electrical generation. This showcased both our project finance capabilities and our use of tax equity. Now, I'm not describing any of these because they're simply the best or the best in the industry or the only, but just to showcase the breadth of what's going on a global scale and what's embedded in various different areas within Citi. Closer to home, we worked with the New York State Energy Research and Development Authority, and we arranged subsidized financing for a wholesale dry cleaning operation in Long Island City, which is where our consumer business is headquartered. We did this to finance efficient equipment to reduce energy demand. The opportunities to invest on a scale basis to drive not just renewable and alternative energy, but all forms of reduction of emission is an extraordinary opportunity today, and an opportunity that will be captured and will utilize a wave of investment capital this decade, which we think will be extraordinary. Now, of course, investments are not the only thing. We have clients that require our advice and our understanding and our access to knowledge and our investment in an infrastructure with which we can gain insights from the broad market. When it comes to meeting the growing demand, we are trying to both focus on reconciling this growing demand for energy with the impact, clearly, on the environment. Now, there are times when regulations don't keep up with our client needs. There are times when clarity of policy doesn't keep up with business that we have to undertake. And there are times that, as a result, we have to create a set of standards with which to operate to lead the industry a step forward. Citi's got a long history of embedding these kinds of standards, whether it's social, environmental, whether it's governmental. We've done so with the Sullivan Principles, the Wolfsburg Principles, the Equator Principles. Building upon this legacy, a group, some of whom are in the room today, Bank of America, JP Morgan, Morgan Stanley, working with Ceres, working with the Environmental Defense Fund, working with the National Resources Defense Council, working with a number of utility clients, as you know, established the Carbon Principles. This Carbon Principles is a consistent approach to due diligence, analysis, and recommendations specifically focused in the U.S. on power production. It's a first step. It's a critical and important step. It's a documented set of industry standards. It's transparent. It's best practices. It allows for every developer of these plants to understand their opportunities and their risks and the impact on pricing of the cost of what actions they will take for many decades to come. And it provides recommendations to them. Now, these Carbon Principles are very specifically documented on a risk basis. We've been conducting this kind of diligence in various different ways throughout the industry for, of course, years and years. This is now a common standard which helps drive the industry forward. It's what we call an enhanced due diligence framework. Now, the process with which we developed this, with NGOs, utilities, financial institutions, it was robust. It was educational for all parties. It resulted in a set of principles that I think virtually all parties thought were groundbreaking. The partners have finalized these principles, and we're now taking the next step. Munis, co-ops. We're taking the next step. Move towards efficiency. We'll take the next step afterwards. This is an incremental approach. There's no silver bullet here. This is step by step, industry by industry, impacting it piece by piece with a collective force, utilities, financial institutions, investors, and NGOs. Now, we'll continue to move that forward. Now, while we're deeply engaged on this issue, we're keenly aware of the challenges that remain. We are particularly, and I say particularly, cognizant of the tension between demand for resources, particularly in energy, and the impact on the atmosphere of greenhouse gases. This is a core fundamental issue. It's a societal issue, and it's a global issue. Andrew Rifkin in the New York Times Science section, April 9th piece, many of you would have saw, captured this in a comment about India's desire to build a 4,000 megawatt coal-fired power generation. He said, and I quote, "Is all of this bad? If you're one of the many climate scientists foreseeing calamity, yes. If you're a village kid in rural India looking for a light to read by, no." It's deep in the soul of every country, every individual, every government to provide a better opportunity. This balance is very hard. This is the key challenge for all of us gathered today, for the numerous public and private and nonprofit institutions around the world. How can we assure that the demands of the millions of people emerging from poverty, moving towards productive steps in an overall economic and societal framework, which, by the way, is to the benefit of all of us, how can we do this, serve this great aspirational tendency, and ultimately reduce greenhouse gases? How can we do this when market conditions are such that we are seeing not only challenges in the financial markets, challenges in the economy, but shifts in wealth across the global scale? The efforts of individual institutions are essential because each one of us is a building block. But clearly, we need to make sure that we have common practices. Clearly, we need policies. Clearly, we need policies and level playing fields. Clearly, we need public awareness. That's why these forums are so valuable across multiple constituencies. You can't be in Boston without quoting President Kennedy. John F. Kennedy, a president that for a brief moment challenged our nation to aspire to a greatness that could only be achieved by a new spirit of collective service, said, "There are risks and costs to any program of action, but they are far less than the long-range cost of comfortable inaction." History, he went on to say, will never accept difficulty as an excuse. Now, while JFK was not speaking about climate change, he certainly could have been. And of course, as Mindy described her children in the introduction, I would say that when my 7-year-old daughter turns to me in bed at night and says, "But why can't there be factories without smokestacks?" The answer is, of course, in all of our hands. At Citi, we're committed to continuing to do our part. We'll develop financial products, we'll develop services that will advance climate solutions. We'll partner in this most important endeavor. We'll do it because it's important, we'll do it because it's right, we'll do it because it's in the interest of our clients, and we'll do it because it's in the interest of our employees, and we'll do it because it's in the interest of our shareholders, who we care so deeply about. Thank you very, very much for your time and attention.
Is my mic on? Great. I'm being heard. I think we have time for just about 2 questions. I've been told there are mics in the room, so Betsy, let's take it away. Who's our first questioner? We've got a mic going to Rich Ferlato.
Good morning, Mr. Klein. Thank you for a very cogent presentation. My name is Rich Ferlato. I serve on the Ceres board. I am the Corporate Governance Director for the American Federation of State, County, Municipal Employees Pension Fund. We've been engaged with Ceres for a long time, and in fact, the last time I was in a room this large was last week at the annual meeting. I think you give a very cogent analysis of risk and how Citi and other financial institutions are looking at risk, particularly the relationship to the subprime set of risk concerns that you opened up with. I think our concern is that whether risk is being managed appropriately at the board level, and that whether the audit committees or the financial committees, the risk assessment committees at the board level are prepared to deal with dealing with these risk concerns, whether it's related to subprime or climate risk or water risk or what have you. So could you tell me, and frankly there weren't satisfactory answers, not that it was a forum for satisfactory answers at the annual meeting. Could you tell me how the board might relate to these questions and how climate risk in particular is related to the strategic planning at that level that the company engages with? Because unless there's direction at the level of audit, corporate governance, I'm afraid that long term, given the pressures on the company, that this might be something that falls by the wayside.
Thank you. Thank you for the question. In particular, with regard to the initiatives here at Ceres as your board position, and with regard to climate change and the like, what we have done, obviously, in embedding our policies and our procedures is embed them from top to bottom. Chuck Prince, as CEO, was an early committed participant, obviously, in much of the issues that have taken place. Pam and her group have been built out with a knowledge that this particular set of initiatives need to withstand all forms of management changes and be embedded throughout the company. So when we put in place enhanced due diligence standards, those due diligence standards fit within the front-facing part of credit and risk and business and analytical decisions that then make their way into our risk chain, which then makes our way up through our independent head of risk, which then reports up to the board in the board committees as currently described and as this firm has always taken in their construct. So the environmental aspect, the aspect that we're discussing, is embedded as part of both our risk advisory, our risk metrics, but also then as well from an advisory perspective, because when we discuss with a client a particular financing or an investment they may undertake that will be, as I said, I think earlier, decades in the making and be in place for decades going forward, and it may be a substantial, meaningful capital commitment from themselves and, of course, capital commitment from a potential financing source like ourselves or others in the industry. Understanding where policy changes may occur, understanding what risks might occur with regard to the technologies adopted, understanding what costs might be undertaken as a result of paths in carbon pricing, carbon taxes, whichever paths take place, is critical. So for us, as an ongoing business, these risks both serve externally facing from an advisory perspective, internally facing from an understanding throughout the organization, through and up and into independent risk. Thank you.
I understand we have one more teed up. Julie Gordy.
Yeah, thanks. Is this on? Yeah, okay. I'm Julie Gordy from Pax World Management Corporation. We have noted with great pleasure Citigroup's increasing provision of sell-side research for asset managers that incorporates environmental, social, and governance factors. And this seems to be mirrored in many of the initiatives that you described and much of what Pam has been doing for about the past, I don't know, while. These are all good things. But one of the, I guess I'm going to ask a challenging question anyway, because this is a plenary and you can do that in plenaries. You talked about our making an investment in the 1990s following that real estate crisis or that financial crisis in technology and innovation. Most of the time when this nation undertakes innovation as a priority, for example, in the previous energy crisis in the 70s, a lot of what comes out of that is better in the way that solves the immediate problem. Financial innovation, on the other hand, has had a really curious outcome. While we have managed to make the amplitude of the swings or the volatility in GDP a lot lower over the past 50 years through some of the actions and the knowledge of the Fed and other institutions, it seems as though the amplitude of the beta, if you will, the volatility of asset management and financial performance in the finance sector has actually gotten worse. That is, we see wider and wider ups and downs and swings and so forth. And a lot of that is attributed, maybe fairly or unfairly, to some of the quantitative engineering in finance. But it has an effect on the real economy, as we just saw in the recent crisis. Is that something that you'd care to comment on? I think for sustainability, we can't afford to be on a roller coaster all the time. We need to be able to commit to things that last for decades and stay committed to them. Thank you.
Well, thank you for that. I couldn't agree more with your closing comment in terms of commitment, sticking to commitment. Obviously, the business of banking is about trust, your ability to serve, your willingness to serve, your continued commitment to serve your clients in good times and bad times. It's a core part of every business that is part of Citi, and I've been part of Citi for 23 years. It's a core part of that principle which says our business is serving our clients, which means that ups, downs in markets, ups, downs in financial performance, you need to be the firm that has both the best-in-class capabilities plus also the view long-term, of being the safe, secure, and capable participants on a global scale. Now, we have 200 million customers or clients around the globe that count on that. So we share your comment that it's critical to be in that position. Whether elements of financial innovation have created distributed risk or created volatility and risk, I think is one of those subjects that we will be all not just analyzing and debating each and every element of it for the years to come, as it's critical for firms like ours who view our core and most relevant participation being serving clients. It's a business of trust. And if you view it that way, your entire goal always is to be in a position to be there to do that on a day-to-day basis. Understand the challenges of the past, understand the issues and risks of the future. That's our goal. That's our commitment. It's a personal commitment, by the way, as well, because that's the role we have to play in that regard. So it's something that is quite meaningful for us. Let me close by thanking you all for allowing me as a banker to be part of this audience. Let me thank you as well for all of your commitment to this effort. I think it's important for everyone. Let me thank Ceres for their work with us and Mindy for the generous introduction. And let me hope that Citi does at least their own bit to further the efforts that are so critical. And let me hope that each and every one of you, to the extent that you can do your bit, just a bit more in these particularly challenging times, can do that. Thank you very much.
That was great. That was just great. Thank you, Michael. I think I've got a couple of microphones here. That was terrific. It hit the nail on the head. It is about what different sectors of the economy could do, what different NGOs can do, and how much more we could do.